E. Identify how transactions affect elements and determine proper classification. Transactions maintain balance under the accounting equation. Every transaction has a dual effect, increasing or decreasing at least two elements. Borrowing cash increases assets and liabilities. Issuing stock increases assets and equity. Paying suppliers decreases assets and liabilities. These changes affect financial statements differently. Some impact only the balance sheet, while others flow through net income and retained earnings. Operating transactions affect both income and equity. Revenue recognition increases assets, e.g., accounts receivable, and equity through retained earnings. Expense recognition decreases assets or increases liabilities and reduces equity. Accrual adjustments, e.g., prepaid expenses, accrued wages, shift timing between periods while preserving the matching principle. Cost of goods sold reduces inventory and increases expenses, impacting gross profit and retained earnings. Financing and investing transactions affect classification across statements. Purchasing equipment decreases cash, investing activity, and increases PPE, non-current asset. Issuing debt increases cash and liabilities, financing activity. Dividends decrease retained earnings and cash, financing activity. Non-cash transactions such as debt conversion to equity affect balance sheet classifications but are disclosed separately in the cash flow notes. F. Demonstrate understanding of relationships among financial statements. Net income links the income statement and equity section. Net income increases retained earnings in the statement of changes in equity and appears in the equity section of the balance sheet. Dividends reduce retained earnings but do not affect net income. Thus, equity reflects cumulative profitability and distribution policy. Cash flow statement reconciles accrual accounting to cash position. Beginning and ending cash balances on the balance sheet are reconciled through operating, investing, and financing activities. The indirect method adjusts net income for non-cash items and working capital changes. Gains and losses from asset sales are removed from operating activities because their cash effects appear in investing activities. Inventory, depreciation, and other elements connect statements. Ending inventory appears on the balance sheet and influences cost of goods sold on the income statement. Depreciation reduces net income while accumulating in contra-asset accounts on the balance sheet and is added back in operating cash flow reconciliation. These interrelationships ensure internal consistency across reports. G. Demonstrate understanding of preparation of each statement. Balance sheet preparation begins with trial balance classification. Assets, liabilities, and equity accounts are organized into current and non-current sections. Adjusting entries, accruals, deferrals, depreciation, are recorded before final balances are presented. The statement must satisfy the accounting equation. Notes disclose accounting policies and significant estimates in accordance with GAAP. Income statement preparation follows accrual and matching principles. Revenues are recognized when earned, and expenses when incurred. Cost of goods sold is calculated using inventory data. A multiple-step format separates operating and non-operating items. Income tax expense is deducted to arrive at net income. Discontinued operations and comprehensive income components are presented according to reporting standards. Statement of changes in equity reconciles beginning to ending balances. It incorporates net income, dividends, stock issuances, treasury stock transactions, prior period adjustments, and other comprehensive income. Each equity component is presented in columnar format, allowing users to trace sources of change. Statement of cash flows, indirect method, adjusts net income to cash from operations. Add back non-cash expenses such as depreciation, remove gains and losses related to investing or financing, and adjust for changes in working capital accounts. Then report investing and financing cash flows separately. Finally, reconcile beginning and ending cash balances to complete the statement. H. Define consolidated financial statements. Consolidated financial statements present a parent and its subsidiary, IES, as a single economic entity. When one entity has a controlling financial interest in another, U.S. GAAP requires consolidated reporting regardless of the percentage owned. The parent and subsidiary may remain legally separate, but their financial results are combined as if they operate as one company. This requirement reflects the principle of substance over form, ensuring users see the economic reality of control rather than just legal structure. Control is the basis for consolidation. A parent is an entity with the direct or indirect ability to determine the direction of management and policies of another entity. Consolidated statements combine 100% of the subsidiary's assets, liabilities, revenues, and expenses, even when less than 100% ownership exists. When ownership is less than total, a non-controlling interest, NCI, is presented in equity to represent the portion not attributable to the parent. The acquisition method governs business combinations. At acquisition, identifiable assets and liabilities are measured at fair value, and goodwill or a bargain purchase gain is recognized. Subsidiary equity accounts are eliminated in consolidation. After acquisition, consolidated financial statements report combined line items, eliminate the investment account, and separately disclose net income attributable to the parent and to the NCI.